Most REITs in the Philippines live and die by mall foot traffic or BPO occupancy rates. But what if there's a REIT that's not tied to shopping malls or corporate tenants? One that quietly earns, month after month, from land that generates power, not retail sales. This is Citicore Energy REIT, the Philippines' first and only renewable energy REIT. While other REITs ride the ups and downs of the economy, CREIT keeps collecting rent from solar farms that power our country. In this video, we dig deep into why CREIT is being called the most stable REIT in the country, backed by real contracts, real sustainability, and real growth. This isn't hype. This is backed by facts, performance, and vision. Welcome back to Thrifty Finance Vision PH. Let's break it down. Instead of leasing spaces and buildings, CREIT leases land to renewable energy developers, primarily those under the Citicore Group. What does that mean for investors? Long-term lease contracts, most spanning 20 to 25 years. Fixed base rent, with an added bonus from the tenant's solar output. Near zero vacancy risk, because solar plants don't move out. And the scale is impressive. CREIT's portfolio includes 14 properties, spanning over 7 million square meters of land, hosting 145 megawatts of installed solar capacity. This setup gives CREIT a stable, utility-like cash flow, something that's rare in real estate investing. It's not just a REIT. It's a piece of the country's clean energy infrastructure, earning quietly, consistently, and long-term. Let's talk numbers. Gross revenues hit 1.62 billion pesos, up 5% from the previous year. Net income reached 1.28 billion pesos. That's an 11% growth from 2023. And most importantly for investors, CREIT declared 0.19 pesos per share in total dividends for the year, translating to a dividend yield of around 6.4% based on the 2024 average share price. All of this while maintaining 100% occupancy, a weighted average lease expiry of 20.7 years, and a portfolio fully backed by long-term contracts. This is not a speculative play. This is a REIT built on predictable cash flow from tenants that need to stay operational, solar farms powering communities. In 2024, it added 2 solar farms, increasing total leased land and boosting recurring income. And more are in the pipeline. Its sponsor, Citicore Renewable Energy Corporation, has 1.5 gigawatts of renewable energy projects in development, all potential future tenants for CREIT. This means as CREC builds more solar plants, CREIT has the right of first offer to acquire or lease the land. That's built-in growth already in motion. But it doesn't stop there. CREIT received a dark green rating from Cicero Green on November 22, 2021, which is highlighted as the first in Southeast Asia. Cicero Green is a leading provider of second-party opinions for green and sustainability-linked bond investments. The dark green rating is the highest score given for environmental soundness of green projects. This rating confirms CREIT's commitment to climate-resilient and environmentally sustainable practices. High marks in sustainability governance, transparency, and environmental responsibility. This isn't just good PR. It matters to global investors who are shifting towards climate-resilient investments. So if you're investing not just for returns, but for impact, CREIT checks both boxes, income and integrity. CREIT may be stable, but no investment is perfect. Here are the key risks to keep in mind. Dependence on one sponsor. Most of CREIT's land is leased to just one group, Citicore Renewable Energy Corporation. While CREC is growing, this concentration means CREIT's fortunes are closely tied to one tenant. If anything affects Citicore Renewable Energy Corporation's operations, it could ripple into CREIT's income. 2. Limited capital appreciation. Because CREIT owns land, not buildings, there's less opportunity for property value growth. The focus is on income, not appreciation. 3. Renewable energy risks. Although solar is booming, the industry still faces regulatory, climate, and technology risks. If solar profitability dips, CREC might renegotiate terms, affecting CREIT's bonus income. 4. Liquidity and market volatility. While it's listed on the PSE, CREIT doesn't always have high trading volume. For long-term investors, that's fine. But if you want to exit quickly during a market dip, it might be harder. These aren't deal breakers, but they're important to understand. Stable income comes with trade-offs, and knowing those is part of being a smart investor. So, is CREIT worth it? In a REIT market dominated by offices, malls, and corporate leases, CREIT offers something different and refreshing. A REIT that earns from renewable energy infrastructure, pays reliable dividends with minimal risk of vacancy, and grows alongside the country's push for clean energy. For long-term, income-focused Filipino investors who want stability over speculation, CREIT quietly delivers. It may not be the flashiest REIT on the market, but it's one of the most consistent. And in today's uncertain times, consistency is king. If you got value from this breakdown, don't forget to like, subscribe, and share this with someone who's looking for safe and steady investment options. Until next time, invest wisely and stay thrifty.